What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is April 28th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to make the rational argument as to why I personally believe that Bitcoin is an asset that everyone should have some form of exposure to. Now, I want to make it very clear right off the bat, this is not direct financial advice. You have to do your own due diligence and make these decisions for yourself. And again, at the end of the day, if you don't feel you understand Bitcoin or cryptocurrencies enough to feel comfortable, then don't make any form of investment until you feel comfortable enough to do so. But in this video, I'm going to be exchanging more on a broader perspective as to why I personally believe that having some exposure to Bitcoin is beneficial compared to not having some form of exposure. And again, it's just my opinion, okay? So we're going to keep it simple. There's three major bullet points that we're going to be talking about, but I do want to let you all know towards the end of the video that we have a sponsored review for Hash Wallet, an innovative hardware wallet solution to store your digital cryptocurrencies at the end of the video. So stay tuned for that. You won't want to miss it. All right, let's go ahead and talk about these three key points. I'll just go ahead and get them out straight away, and then we'll dive deeper into each of these. First off, we have to understand that Bitcoin itself is a great tool in order, in this case, to possibly become a store of value with its cap supply at 21 million coins and no inflation beyond that point, but over the next few years, a decreasing inflation rate until we reach that cap supply. It's a very big selling point for Bitcoin. The second thing is the macro environment, understanding what's going on in the world around Bitcoin, and along with that, the size and scale of wealth in other markets across the world that have a chance to flow into new assets like Bitcoin. And the third aspect here that we're going to be talking about is simple diversification and exposure to high yielding or performing assets, which Bitcoin has been leading the way with in many regards, okay? So we've talked about these 3 points. Please give me the time of day, though, to explain a little bit and more in depth as to why these are all valuable, because I think not understanding the context behind it is going to leave a lot of investors confused or possibly caught up in the short term kind of thinking of watching the day-to-day price moves of Bitcoin. All right, so let's just go ahead and talk here first about the first topic we discussed, which is Bitcoin as an asset, understanding its fundamentals, its cap supply. So we've already talked about the halving event. I think many of you here probably know about the halving event, which is actually coming up here in the next coming weeks. Basically, the fixed schedule supply reduction per block of Bitcoin. Basically, to put that in simple terms, as every 10 minutes there's a generation of a couple of Bitcoin, that number that's generated every 10 minutes is going to be cut in half. And this basically leads to a supply shock over the next coming months and the next few years in Bitcoin's price, which leads to these cyclical waves that we've seen here on the chart. And not to mention the expanding cycles that we've seen. So we can see here that even though we have expanding cycles for Bitcoin, we can see here that over time we continuously, time and time again, have these very exponential rallies where valuations start to rise not only to new highs, but also usually tend to set new lows, in this case, new significant lows that show that buyers are coming in at higher levels, in this case, when we have corrections, and also are willing to pay higher premiums as we go higher, as there's more users on the network, as there's more people owning or understanding Bitcoin as an asset, and then also in this case, as the halving event causes a supply shock in regards to the demand that's currently in store for Bitcoin in this case. So there's a certain amount of demand on the market on a day-to-day basis. That number tends to grow after the halving event over the next coming weeks and months after the halving event as price starts to pick up, and then we enter into these exponential cycles. And that initial spark to the cycle is caused from the reduction in new Bitcoin being issued. So again, a massive supply shock, and therefore demand starts to heavily outweigh the supply side, which pushes prices even higher. All right, so very important to understand that cap supply. And also, if you're just talking about it on a fundamental basis, the important thing to realize is we take a look at a lot of major world assets like gold, in this case, that has a very limited supply, usually only has about 1 to 2% inflation every year, meaning that we basically mine and refine, in this case, 1 to 2% new gold every year. So it increases the base supply. So after 50 years or so, you're going to probably have 50 to 75 years. In this case, you're going to have a doubling of the gold supply. But it's still seen as a world reserve store of value. Whereas in the case of Bitcoin, we know that there will never be more than 21 million coins. And that's the very big selling point here. Not to have something that's just limited in nature, but something that's finite. So in my opinion, that makes it the ultimate store of value. I mean, if you're really looking for something that keeps things limited, it's not deflationary in the sense that we're starting to take apart some of the supply to a large degree, and it's also not inflationary like gold is at the end of the day. It does have an increase in supply. So again, this is the perfect medium here where we have a fixed supply, the perfect amount in order to have a store value or a hedge in this case that you could store wealth. Now, next off, I want to talk about the macro perspective because this really puts things into context. We have markets across the world, whether it's equity markets, whether it's treasuries or other government bonds, currency markets that total into the hundreds of trillions of dollars when you're really taking it all into account in this case between currency markets, bonds, and also equity markets. We have so much wealth parked in the world right now that is going through a very turbulent time. These assets are tied, all three of the ones we just mentioned are tied to the actions of governments and the actions of certain economic players, all types of different elements in the real world. And when these owners of these assets in this case, right, these assets that are worth these trillions of dollars go through these turbulent times, investors look for alternatives. They look for ways to park their capital elsewhere. And there's sometimes some direct reasons for that. Two markets that we can build a very clear example of this for are, in this case, saving deposits, when people just are owning physical cash or currency of some form. And along with that as well, treasuries or other government bonds. Now, these again are multi-trillion-dollar markets. There is a ton of wealth parked in here. It's likely that if you own some form of 401k, if you own an IRA, in this case, if you have any kind of retirement account, that you likely not only have money in your savings account like practically every American or every other citizen has in the world to some degree, but along with that, in this case, you've also got exposure to some form of government bonds, or otherwise known as fixed income assets. Now, these again are multi-trillion-dollar markets, but I want to talk about something that's changing in regards to the world stage, and it's even happening to the large giant itself, the United States, and that is the concept of negative interest rates and hyperinflation. Now, again, these have been kind of things that, again, now we've known about hyperinflation in this case, but I would doubt I would doubt anyone who would say that we thought a year or two ago that it would be possible for the United States to be seeing some form of hyperinflation or some form of negative interest rates, where, to put it in context, we're printing excessive amounts of money when we're talking about hyperinflation, or just mass amounts of inflation. And the second component here being negative interest rates, and the component that you are actually getting penalized for saving money. You're having to pay the bank to hold your deposits. Whereas instead, it previously was that in positive interest rate territory, which is what the norm has been for practically all of history, in this case, you got paid to have your deposits there because the bank would be lending it out to other people. So we're in this very interesting gray zone now where this kind of twilight zone mentality of central bank monetary policy has become the norm. We can see here that the Federal Reserve balance sheet, this is the central bank of the United States, going here from about $4.2 trillion in assets to $6.5 trillion. And that number is set to go all the way to $9 trillion. We're barely just getting started with this. So we're nearly doubling the amount of base monetary supply in the economy. We're injecting a ton of new capital and buying off a ton of assets like treasuries and things of the like that are driving yields even lower, because as the price of treasuries and government bonds go up, the value in this case will increase on those bonds, but the yields drop. The yields in the sense of the percentage of basically yield that you get paid in order for holding that government debt start to go down towards zero and test into negative territory. And again, we can see here that this is happening with all central banks, from the European Central Bank to the Bank of Japan to the People's Bank of China. You can see here that this is just measuring those 4 central banks. There's other central banks in the world that would show that this number is even larger. But we've added trillions of dollars of assets in this period of time, and that number is only going to expand. And then also, again, we have the central bank rates themselves, right? This is very important to keep in mind here. We have Switzerland, for example, down to basically almost a negative percentage point. The Japanese interest rate down negative 0.1%. The European Central Bank rate, as well as the Swedish interest rate, at 0% exactly. And then you have a variety of banks, from the Danish, the British, the Israeli, American, Australian, Canadian, New Zealand, and Norwegian central banks that are very, very close to testing not only 0% interest, but along with that, stepping into the same ballpark that the Swiss and Japan are in with negative interest rates. Don't doubt for a second that over the next year or two, we are going to have to probably put ourselves in a position where we test with negative interest rates, or that central banks will be curious enough to try this. And quite frankly, we're very close to it. We've gone from about 2.5% down to a quarter of a percentage point. Is it too difficult to think that in this short period of time that we've dropped so much that we wouldn't take that step into negative interest rate territory? that this won't be enough and that we have to stimulate even further. It's crazy. I mean, this is again Japan here, that during the crash of everything went down to negative 1%, but still can't escape out of negative interest rate territory. It's still there. So we have to understand that this is going to have massive ramifications. If you're a saver right now, if you have money in a retirement account and fixed income assets, you're going to be penalized for this, because if you have money in your savings account, then you're getting penalized in this case for having money in a bank, right? You're basically going to be paying out interest to your bank, crazy enough, in order to hold your deposits. And along with that as well, and just to be clear, this has been a reality in Europe and Japan for the last few years, but along with that as well, you've also got treasuries and government bonds that are going to start penalizing you for holding it. You're going to have to pay in order to hold this IOU that the government has given you, right? It doesn't make much sense, right? Now, of course, the value of those treasuries and bonds will go up a little bit in the short term, but again, the negative yield that you're being penalized with eventually will start to outweigh the increase in bond price. So again, very important to keep in mind here. And then also, again, if rates were to normalize eventually, again, the bond value is going to drop quite harshly as well. So again, at the end of the day, most people are going to get screwed in this if they're holding these assets long term. So I guess this leads us really to our third point here, right? Talking about looking at other assets in this case, not only in the sense of performance, but also assets that can hedge in this case, right? The importance of diversification during these times. And Bitcoin was one of the best performing assets here. This is a recent article that was put together for the last 12 months of price action. And we can see here, Bitcoin has actually performed quite nicely. We'll go ahead here and bring up this chart. This compares Bitcoin to a variety of assets. It takes a look at, for example, TLT, which is U.S. Treasuries. We've got GLD, gold, QQQ, which is the NASDAQ. In this case as well, you've got a variety of things. The Dixie, this is the dollar index. You got a lot of other different indices, as well as the SPX, which is the S&P 500. You've got oil. And in this case, you've got a lot of different measures here. And you can see across all these different markets, Bitcoin has been the best performing asset. With all its volatility, with all the scare, with all the crazy price increases and price drops that have happened over the last 12 months, we're still the best performing asset. Now again, even if you took it here from exactly 2020, we're still the best performing asset here. Very important to take into mind here. Very important. And I think this really speaks to the nature of Bitcoin being an emerging asset and why it's important to have some form of a diversification and exposure to these assets. Not saying you should put all of it in Bitcoin. That's not the kind of risk profile that anyone needs to be taking, or at least the vast majority of people don't need to be taking. But it's understanding that there aren't many markets in the world that have this kind of small size of scale but potential to grow. All right, let's just take a look, for example. This is a really great visualization we've talked about before on the channel from the Money Project. It came out back in 2017. And interestingly enough, we're actually not too far off from the valuations here. Bitcoin is currently at around 140 billion instead of 100 billion from this chart. The rest of the cryptocurrency market cap is around 87 billion right now. And Ethereum at the moment is sitting at around 21, 22 billion. So a little bit smaller. But we can see here, this is roughly about the size of the crypto market at the moment. You can see some of the biggest tech companies here. You can see the 50 richest people in the world, California's GDP, the Fed's current balance sheet, currency markets, gold, the stock market. You can also see global money supply, which talks about the narrow money and broad money supply here. Now, I want to focus in on two categories here. We talk about Bitcoin being able to serve as a store of value in this case and start to swallow up some of the valuation of store of valuation, basically the market for hedges and stores of value. Well, gold is probably one of the best ones we can look at here, and this is taking gold at a $7.7 trillion market cap, in this case for the overall supply of gold multiplied by the current price per ounce. And in this case, the actual price is a little bit higher, so we're over $10 trillion market cap here. So $10 trillion, pretty crazy stuff. But even bigger than that is the global money supply. And in this case, we're talking about nearly, in this case, if you want to rough it off here, right, you're talking about well over, in this case, I would say through the broad money supply that's measuring both of these, $90 trillion, right? Now, again, this number's probably increased over time, but let's just give or take it, be very conservative about it, $90 trillion, in this case, in the form of currency wealth, and then also through gold. That's not including treasuries. It's not including other forms of government bonds. We're talking, again, about this 100 trillion plus market in this case, right? probably up to $200 trillion when we're talking about the size of government debt across the world, right? Give or take somewhere in that ballpark. Bitcoin right now is sitting at around $140 billion market cap. It's this little square here, a little bit bigger. You think there's a chance that that could easily 10x and go to $1 trillion market cap? How about 2 or 3 trillion? Would that really be too crazy to think that we could see valuations go that high and that Bitcoin could become one of the many asset categories on this list that holds trillions of dollars of wealth? I think it's very realistic. It's not going to happen overnight. If that's what you're looking for, then sorry, this isn't the market for you guys. This is a market that's going to take some time to develop. But having anywhere between 3 or 5% exposure in your portfolio, you will have that 3 to 5% not only serves as a hedge in case Bitcoin does succeed, but it also doesn't risk the vast majority of your wealth in this case. It's a hedge on betting, in this case, that Bitcoin is going to be able to serve as a hedge, that it's going to be an emerging asset, that it's not going to be a small speculative $140 billion asset. It's going to be a multi-trillion-dollar market. That's the whole goal there with having some exposure to Bitcoin. It's to hedge against the depreciation of currencies across the world, the depreciation of you holding on to bonds or treasuries where you're starting to be penalized for holding on to those bonds. And along with that as well, having your money in deposit accounts. And then also, not to mention, it's not just on the negative interest rate side, it's on the printing side through inflation, through central bank monetary policy, where they inject massive amounts of cash and they depreciate your purchasing power. You think that's helping out the everyday Joe? It's not. Anyways, I've rambled on enough. I hope you all enjoyed this segment here. Let's go ahead and dive straight into our review for Hash Wallet. Alrighty everyone, so let's go ahead and spend some time to take a look at today's sponsor, and it is no other than Hash Wallet. Now for those of you out there who care about the security of your digital assets as much as I do, I highly recommend you stay tuned for this review to learn about what they're doing. To put it simple, Hash Wallet is aiming to build an innovative hardware wallet solution for your digital assets. They're not only using a lot of cutting edge techniques in order to make sure that anything important in relation to your wallet is done offline on the hardware device, but along with that, they're utilizing a lot of interesting technologies like biometric data in order to validate that any transfer of funds or movement of your crypto is done by you and you only. And I really like the approach of Hash Wallet. I've seen a lot of software wallets and a lot of hardware wallets, and I gotta say this is much more, I think, of a consumer-facing product at the end of the day for a hardware wallet solution. So we're not only gonna take a look at the actual product itself, both on the software and also hardware side, but along with that, talk about the security, how it acts in a secure nature, and also about their Indiegogo campaign where they're raising to make this a reality. All right, so let's go ahead and dive straight into the actual product. So first off here with the Hash Wallet, we have to understand that there are two components to it. There is the hardware wallet and the software wallet. The hardware wallet is where you're actually going to be not only storing the keys in this case, but also validating with your biometric data in order to make any form of transaction. As you can see, it's very sleek. It's in the shape of an average debit or credit card. And you can see here, you have the biometric input here where you put your thumb or your finger in this case. That's again unique to you. It's a unique validation and key tool in order to make sure that any transactions are happening from you. And outside of that as well, of course, you can see the address here. You can see the amount of crypto you're sending to validate that you're sending the proper amount to the proper address. And you can also use the software wallet in this case in order to manage your portfolio or watch what kind of assets that you have. And it's important to note here that the Hash Wallet is a multi-asset tool in this case. So you can store a variety of cryptocurrencies inside your Hash Wallet, which is pretty unique. So let's go ahead here and talk a little bit about the actual security aspect here, right? So how does Hash Wallet actually keep your funds secure? Well, I want to go ahead and just talk a little bit about some of the potential attack vectors. A lot of the even hardware wallet solutions deal with a lot of issues that software wallets can deal with. Man-in-the-middle attacks, for example, where someone in the middle of you actually processing or transferring this information, seeing your private key or that validation information and being able to corrupt it or use it to their advantage. And then along with that as well, in regards to programmable wallets, there's a lot of flaws that can inevitably leave you vulnerable to other forms of attacks or possibly making problems yourself in this case when you're dealing with seed phrases and a lot of other aspects of private key management. So the way that the wallet actually goes about keeping your funds secure is that no one, not even you the user, will actually see the private key that gets generated inside the wallet. It's all done offline and it's not programmable, so people can't take it apart, people can't decrypt it. In this case, everything is done on the wallet and it's completely secure and offline. So if no one sees the private key in this case, and the only way that you can actually access that private key is through your biometric data, you've killed off any points of attack in this case. It's not generated on some website, it's not generated through some software platform, and even through a hardware wallet system that can be compromised. So I think it's a really interesting approach at the end of the day. And the great thing about it as well is that it's utilizing your fingerprint for the final validation here, as well as making sure that you know exactly what action you're validating. So really cool here, and something so small that you could fit inside your wallet. I think it's a really big step and improvement from some of the kind of legacy hardware wallet solutions that have been in the cryptocurrency space, and again, is much more consumer facing. Now again, as we talked about, you've also got the Hash Wallet Manager. So they're not only going to be building a mobile, but also desktop version that will allow you to actually visualize your current cryptocurrency holdings. Pretty self-explanatory here, nothing too crazy or innovative, but this is where you can actually initiate transactions. So you initiate, for example, that you want to send a certain amount of cryptocurrencies or a certain type of cryptocurrency in a certain amount to a specific address. And then you actually have to utilize the hardware wallet in order to sign it with your biometric data. So again, very clean user experience here. You guys know I'm a big user experience buff here, and I love the design of the wallet here. Very sleek, very simple, doesn't overcomplicate things. Now, all in all here, the product itself is very clean, and I like the aspects of its security here. So I recommend, if you guys are interested, to go through the website to learn a little bit more about the product, watch some of the videos that they have showcasing the actual product functioning, and you can also check as well the Hash Wallet Indiegogo campaign, where you can see where they're at currently in regards to progress in developing the wallet, and also possibly get your hands on one by supporting the project. So they're currently aiming to raise about $54,000 here in regards to their campaign, with the flexible goal in this case of possibly raising more. So I recommend you guys take a look here, learn a little bit about the product here. You can read through the campaign here, see some kind of design concepts here, and see the different perks that they offer. But I highly recommend you guys give them a chance and check them out. I'm always very pleased to see more hardware wallet solutions coming out, and just generally wallet solutions in the cryptocurrency space. And I think Hash Wallet in this case has a real chance of competing with the likes of Trezor as well as Ledger. I think that we need something that's much more consumer facing and sleek, and I think in this case this really awesome merge between a clean user experience on the software side and also a clean user experience on the hardware side is what's going to be able to take this to a much larger mainstream audience. So if you guys are interested, check out the links down below in the description to learn more and get your hands on a Hash Wallet today.